Hey there, legends in the making. Welcome to Legend Finance, the channel where financial dreams grow and success stories are born. Today, we're going on an adventure that goes beyond the usual and mixes in the extraordinary, the journey to 1 million. Now, 1 million is no ordinary number. It embodies ambition, perseverance, and a relentless pursuit of goals. So what does a million mean in your financial dictionary? Is it $1 million in savings, investments, or net worth? Regardless of the form, a million signifies a landmark of financial triumph that each one of us aspires to reach. So hold on tight as we embark on the epic quest, the road to 1 million. We can assure you that the path will be challenging and the climb steep, but remember, every financial legend has to start somewhere. And on this journey, we're all in it together. Let's chase those financial dreams and make our way to 1 million. After all, here at Legend Finance, we're all about turning financial dreams into legendary realities. Buckle up, because our journey begins now. The math. To generate wealth, imagine you have $5,400 post-tax every month, which you invest for an average return of 8% per year, the historical average of the S&P 500. This scenario does require a substantial investment of $64,800 post-tax per year. Now, it's important to note that an 8% return isn't a guarantee. It's the historical average. The past doesn't necessarily predict the future. Also, for many of us, the possibility of investing $64,800 post-tax every year is not feasible, especially considering that the median salary in the United States is closer to $55,000 to $60,000 per year. In addition to this, if someone has $64,800 to invest annually, they will still have expenses like rent, groceries, car payments, insurance, and more. Hence, for someone to have that amount of post-tax investment money, they likely have a pre-tax salary in the range of $150,000 to $200,000 per year. These individuals are probably not reckless spenders and may not have dependents. We will soon discuss ways of achieving the goal of investing $64,800 per year without solely relying on a traditional job. But for now, let's explore the math a bit further. If in year one you start with $64,800 and assume an average market return of 8%, your balance at the end of that year would be $69,984. If you begin the next year with that balance and add another $5,400 a month over the course of the year, your balance at the end of year two would be $145,566. This pattern continues year after year until year 10, when you reach millionaire status. An interesting aspect of this compound interest scenario is that after 10 years of investing, even though you contributed $648,000, $365,000 of your $1 million balance comes from interest. Therefore, a large chunk of your $1 million balance at the end of 10 years still comprises savings. So let's now discuss the mindset and the principles needed to reach this financial goal. Mindset. To achieve a goal as grand as amassing $1 million in 10 years, you need to genuinely believe in your abilities. Keep a positive attitude and an affirmative mindset. Reject negative thoughts that downplay your skills and potential. Rather, adopt a proactive statement like, in 10 years, I'm going to make $1 million by focusing on my strengths, wisely investing my time and money, and making prudent decisions. This positive outlook can subtly influence your attitude towards your goal and significantly impact your progress over time. Lastly, don't let naysayers, even loved ones, discourage you. Everyone has a unique skill set capable of generating wealth. Remember, it's not an impossible task. Now, let's develop this roadmap. Aggressive savings. To reach $1 million in 10 years, the first principle is aggressive saving, which demands sacrifices in spending habits. It's essential to be aware of your expenditures, cut back where necessary, and exercise discipline to forego certain entertainment opportunities. When receiving a raise or promotion, avoid instantly upgrading your lifestyle. Optimize every dollar you get. For instance, instead of keeping excess savings in a bank with low interest, move them to a high-yield savings account. The key isn't necessarily how much you earn, but how much you save. Even someone earning $700,000 annually but spending most of it isn't really saving. The goal is to maintain a high effective savings rate. Now, on to the next point. Additional income. If you're in a 9-to-5 job that doesn't pay much, it's improbable to reach $1 million within 10 years unless you have a high-paying job or equity in a successful startup. While you should pursue opportunities at your current job, think about generating additional income by starting a side business, which gives you more control and is not subject to employer-imposed earning caps. In these ventures, your pay is directly tied to your effort and results. Regular jobs offer stability, but they may lack adequate reward structures, especially if extra effort goes unnoticed. By focusing on additional income streams, you can begin to accumulate wealth, even if you can't initially invest large sums. As you gain skills and discipline, more opportunities arise. A critical concept here is the disconnection of time and income. Time disconnection. Decoupling your time from your compensation is key to earning more. Naval Ravikant asserts that you won't get rich by renting out your time, as lifestyles often inflate along with income, limiting savings. Though you could accumulate wealth in high-paying jobs, it's crucial not to let lifestyle expenses ramp up too quickly. If not in high-income roles, consider careers that aren't time-dependent. Examples include realtors who earn commissions, software sales positions with large bonuses, logo designers who charge per project, novelists who earn royalties, and e-commerce store owners whose earnings increase with sales. The common thread among these jobs is the lack of a direct correlation between time and income. Once you've established your income, the next step is to strategize how to invest it. Appreciating assets. When you're young, it's advisable to take calculated risks to grow your money quickly. While index funds offer an average return of 8 to 10% annually, if you're comfortable with higher risk, consider growth stocks or individual names. This can be particularly effective in a tax-advantaged account like a Roth IRA, where gains are tax-free. If choosing index funds, consider options like Fidelity's FXIX or Vanguard's VFIAX, and for ETFs, VO or SPY are good choices. Another strategy is investing in appreciating assets, like real estate, which allows you to leverage your returns. For example, if you invest $50,000 in a $250,000 property, 20% down payment, and the property appreciates by 5%, the property value becomes $262,500. This results in an unrealized gain of $12,500 on your $50,000 investment, effectively a 25% return on investment due to the power of leverage. However, this is a best-case scenario. When investing in cash-flowing assets or other types of appreciating assets, it's crucial to do thorough research. Also, it's helpful to track your net worth to stay accountable. Net worth tracking. To start, using your net worth tracker on Google Sheets is an excellent strategy. This will help you visualize and manage your assets and liabilities and monitor the progression of your net worth over time. Here's a more in-depth look at how to use this net worth tracker. Assets. The green section at the top of the tracker is where you'll list and track all your assets. These can include bank account balances, investments, retirement accounts, real estate, personal property of value, and any other assets you may have. Make sure you include all forms of your wealth and update these values for each period you choose to track. In this case, every 6 months. Don't forget that if you have other accounts or assets not listed, you can add new rows to accommodate them. Liabilities. The yellow section is for documenting your liabilities. These are any debts or financial obligations you have, like a mortgage, auto loans, student loans, credit card debt, personal loans, or other forms of debt. As with your assets, update these values regularly. It's crucial to have an accurate picture of your debts to effectively track your net worth over time. Net worth calculation. Row 30 is where the tracker calculates your net worth. This is done by taking the total sum of your assets and subtracting the total sum of your liabilities. This figure represents your net worth and is a crucial indicator of your overall financial health. Visualizing your progress. As you continuously update your asset and liability balances, the graph at the bottom of the tracker will automatically populate and provide a visual representation of your net worth over time. This can be a powerful motivator, as you can literally see your wealth growing or identify if there are periods where it may have decreased. With your net worth tracker in hand, you're better equipped to take the next steps towards your goal of $1 million. You can identify areas where you may need to cut back, see where you're making significant progress, and continually adjust your financial strategies as needed. However, remember that reaching such a significant financial goal also requires strategic planning outside of tracking your net worth. For instance, if your current income isn't high, you might need to explore additional income streams. This could include starting a side business, freelancing, investing in real estate, or taking on part-time work. It's also essential to invest wisely. Consider diversified investment strategies that balance growth and risk, such as a mix of index funds, ETFs, and individual growth stocks. If you're comfortable with it, you can use leverage to enhance your returns, for example, in real estate investment. However, always do your homework before engaging in leveraged investments, as they carry higher risk. Lastly, continually educate yourself about financial management. Resources like our video on going from $0 to $100,000 in 1 year can be incredibly beneficial in equipping you with the knowledge and skills needed to decouple your time from your compensation and ultimately increase your earning potential. And there you have it, my legendary friends. We've reached the end of this incredible journey on the road to 1 million. But remember, it's not about the numbers, it's about the knowledge and financial empowerment we've unlocked together. Throughout our adventure, we've explored personal finance, sharing tips, tricks, and strategies to help you level up your financial game. We're grateful for your support, even if we haven't seen your comments and messages firsthand. As we move forward, the road to financial success continues. We'll keep bringing you expert advice and diving into the latest trends. We're here for you every step of the way. Thank you for being part of our Legend Finance community. Stay tuned for more legendary content, and remember, stay legendary.